Waiting has a negative value. In continuous time optimal stopping, the optimal exit threshold is often higher than intuition suggests. We derive it from first principles, show how volatility and discount rates shift it, and explain why your entry price should never drive your exit decision. Imagine you hold 1 unit of an asset. Its price follows a geometric Brownian motion, a standard model where returns are random but drift upward on average. Your goal is to sell at a time that maximizes your expected discounted profit. The twist: you can wait, but waiting has a cost, because money received later is worth less. So you must choose a stopping time, a random time to exit, that balances the benefit of waiting for a higher price against the cost of discounting. We formalize the problem. You want to choose a stopping time tau to maximize the expected value of the discounted profit. The profit is the price at exit minus your cost basis k. The discount factor e to the minus rho tau shrinks future profits. This is a classic optimal stopping problem. The value function v of s is the supremum over all stopping times of this expectation. We will solve for the optimal threshold s star. This problem transforms into a free boundary problem. In the region where you continue holding, the value function must satisfy a differential equation. This equation comes from dynamic programming. The expected change in value plus the immediate payoff must equal the discount rate times the value. The boundary conditions are crucial. At the optimal threshold s star, the value equals the profit from exiting, and the derivative of the value equals 1, ensuring a smooth transition. This is called smooth pasting. Solving the differential equation gives a closed-form threshold. The optimal exit price s star equals beta divided by beta minus 1 times the cost basis k. Beta is a function of the drift mu, volatility sigma, and discount rate rho. For our example, with mu equal to 5%, sigma equal to 20%, and rho equal to 10%, beta is about 2.73. That means s star is about 1.57 times k. You should wait for a 57% gain before selling. Here is the first surprise. When volatility increases, beta decreases, and s star increases. That means you need to wait for an even higher price before selling. This contradicts the intuition that high volatility should make you exit quickly. The reason is that higher volatility increases the option value of waiting. The potential for a much higher price outweighs the risk of a lower price, because you can always sell at the threshold. So in high volatility environments, the optimal strategy is to be more patient, not less. The second surprise involves the discount rate. A higher discount rate means you value future profits less. You would think that would make you want to sell earlier. But the math says the opposite. When rho increases, beta decreases, and s star increases. You need a higher price to compensate for the high cost of waiting. Because waiting is expensive, you demand a larger payoff to justify it. So a less patient investor actually sets a higher bar for exiting. Perhaps the most counterintuitive result is that the optimal threshold does not depend on your initial price. It only depends on the parameters, drift, volatility, and discount rate. This means that whether you bought at 50 or at 100, the optimal exit price is the same. So the fact that you are already up 20% is irrelevant, unless the 20% exactly matches the required return. Your cost basis should not drive your exit decision. Only the current price and the parameters matter. Let's compare the intuitive approach with the mathematical optimal strategy. Intuition says sell when you have a target profit, like 20%. The math says sell only when the price reaches S star, which could be much higher. Intuition says high volatility means run. The math says high volatility means wait for a higher price. Intuition says a high discount rate means sell now. The math says a high discount rate means demand a higher price. The gap between intuition and math is where money is lost. Let's plug in the numbers. With a drift of 5%, volatility of 20%, and a discount rate of 10%, we get a beta of 2.73. That gives a threshold of 1.57 times the cost basis. So you need a 57% gain to justify selling. If your cost basis is 100, you should wait for a price of 157. This is a concrete example of how the math translates into a specific trading rule. What does this mean for real trading? First, you should not set arbitrary profit targets. Instead, compute the optimal threshold based on your estimates of drift, volatility, and discount rate. Second, in high volatility markets, be patient and wait for a higher price. Third, if your discount rate is high, you need a higher return to justify holding. Fourth, ignore your entry price when deciding to exit. Finally, remember that this model assumes a constant drift and volatility, which is rarely true in practice. But the qualitative insights hold. In continuous time optimal stopping, waiting has a negative value. The optimal exit threshold is often higher than intuition suggests. Higher volatility and higher discount rates both raise the required price. And your entry price is irrelevant. These insights come from a rigorous mathematical framework, not from market folklore. We produce evidence-driven finance and quantitative strategy content. Your engagement helps us continue. Thank you for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.